Hello, everyone. Scott Schwartz here, nevertoomuchmoney.com. I've reverse engineered the way banks and the wealthy make money so my clients can do what banks do rather than what they tell us to do. Take back control and become their own virtual banker. Now, I wanted to talk today about guarantees in the investment industry. If you've done any sort of investing, you know that you're signing statements that basically nothing is guaranteed. There are guarantees in the investment world, but it guarantees the company, it guarantees the advisor, and they really serve as anti guarantees for you and I, the investor. Anytime we buy something, we want to know it's backed by a good guarantee. What happens if it doesn't perform, if it doesn't do what you claim it does? Well, it's very different in the investment industry, though. Let me show this material to you. And I'm not going to read the whole thing. The second paragraph, the second line there mentions we're looking at the S&P 500 index over a 40-year span. So think about that. S&P 500, you're talking about the best, the biggest of the companies that are measured. So we're taking only the best, and then a 40-year span, we're taking out the outliers. We're taking out the fluctuation of market risk, the highs, the lows. And we're smoothing out the numbers because we're looking at a 40-year span. What would happen if you had actually received annual returns that matched the S&P 500 for 40 years? You would have averaged 8.33% per year. However, when you consider that most mutual funds don't come close to that, but rather they are subjecting you to annual fees. Look at the average mutual fund expenses there. They total 4.05%. So you might think, oh, there goes half of my profit from the 8.33%, which wasn't really realistic to begin with. But no, it's less than that because where are the taxes coming from? Remember, the average mutual fund expenses, you owe those regardless of if that fund makes money or not. But the taxes come out of what? They come out of what you show to be profit. So taxes come out of the 8%. Let's keep the math simple. Say you're in the 25% tax bracket. Let's take a quarter of that away. Now you're down to 6%. Now you take 4% of that away in fees for the mutual fund. Now you're down to 2%. And you know what? We haven't even talked about inflation at all. That is the guarantee you get from traditional investments. You're going to pay that 4.05% in mutual fund fees on average. That comes regardless of whether the fund makes money or not. That is your guarantee. You're guaranteed to pay taxes on the gain, and inflation is going to dilute the value of those gains. Now, I've told you the last couple of times that I've done my live streams about the Reverse Engineer Banks Challenge, which is next week. Please sign up on one of the links down below, nevertoomuchmoney.com, reverseengineerbanks.com. And there, one of the things I'm particularly proud of is you will get a guarantee from me, my personal guarantee on the performance of your money. So please do tune into that, sign up for it, and see what the multifaceted guarantee is that I have for your money that's going to completely bypass what I just showed you with respect to the traditional investment of mutual funds. I hope to see you there. I'm Scott Schwartz from nevertoomuchmoney.com. Have a great day. Have a great night, everybody.